If you just look at some of the simple things, like so Chinese to growth is actually, demand growth has actually been revised slightly down on industrial, demand going forward for the next year or two. IHS experts talking about the actual global oil demand growth. I spoke about it on the dirty side, but actually we think it's quite robust, with 1.2 million barrels per day for 2016, and then 1.5 for 2017. So it's really healthy. The forecast from an oil price point of view for the Brent for 2016, I'm going to use digits, is 38.49. It's quite conservative, and then increasing up to 48.87 for 2017. We have done some revisions throughout the year. We have actually reduced them down. It's still below 50. There are some upsides to this risk, though, and ahead, near term, if you get ahead of the balance and the actual overshoot. Once balance is actually reached as an impact of the low OPEC spare capacity, it becomes more evident. The assumptions of this actual oil price, which I just mentioned, below 50, is actually saying the US production keeps on declining to allow for this balance to be absorbed. There's no cuts in OPEC for this year, and demand remains robust at the 1.2. If we look at the order book, it goes into a little bit more detail. It's very high level. The actual total product tanker fleet, and this is not including the LR2s going downwards, is going to reach more than 193 deadweight tons by 2021, which is an additional 40 million deadweights from 2000 level. It's positive, though, because demand for the petroleum products continue to actually grow. Refinery capacity is likely to increase the ton miles demand. So the order book actually doesn't look too bad at the moment. The two things which I really want to take away, though, from a fundamental point of view, before I hand over to Ben, is demand growth for diesel and gasoline will be the major contributors of the refined products growth. Demand for diesel will grow in the Asia-Pacific regions. Europe will remain a major market for diesel. The opportunities for diesel to go from the US to Europe is a good probability. So I'll hand you now over to Ben for the panel. Thank you very much.
Between the owners on the panel here, I think we're talking about for as little consolidation as there is in the shipping market, this is a pretty consolidated group on the panel. So really some of the luminaries of the space, and hopefully they have some answers for us. My first question is, why in the world, after a year like 2015, are the stock prices not higher? And I don't have a good answer, so I'm just hoping maybe that somebody out there does. No?
No good. Well, I guess investors are scared of profits, so they don't want profits and they don't want dividends, and they don't want areas that have good demand growth, and they certainly don't want to invest in the side of shipping that has the lowest new building supply forward on order. So maybe they're afraid of actual success at the moment, because there's nothing really wrong in the spot markets. If we take today, most of the product tanker stocks went down. Dry cargo, of course, went up. It should do. After all, asset prices are falling. They're making operating cash losses. There's tremendous liquidity issues in the market. Everything that an investor is looking for. Today, there are market reports. I mean, these are factual. TC5, there are outstanding cargoes with charterers trying to fix forward dates. The market is expected to continue to firm. TC2 has been good activity today with more TA inquiry, and end of March, early April, and with West Africa inquiry strong, we should still see rates looking to push up. So there's really nothing wrong in the market. All of these companies are creating good profits at the moment. They're returning capital to the shareholders. They're consolidating the industry, not necessarily in acquiring each other, but they are taking on consolidating in forms of pools, etc. The market itself is probably misunderstood. And I think a lot of this is just attention to too narrow a spectrum, because I think that all of these companies would say that their first quarters of 2016 are pretty similar to the first quarters of 2015. Now, what's incredible is that all I've heard of in every one of my meetings, and I'd be interested to hear these guys today, is meeting after meeting, someone sits in front of me and says, "Can you explain why the rates are so low?" This is the cup half empty. I think all of us would say, "Wow, isn't it amazing that the rates are so high? How can the earnings be more or less the same in 16 as they were in 15 when we've had no winter?" So I think Ben has a good point. I think that the truth of it, however, lies in liquidity or liquidation. There isn't a single company, public company in the product tanker market that hasn't suffered private equity, multi-strat, or hedge fund angst around energy or portfolio management in this last 7-8 months. Their shareholding bases have been turning over hard. Shares are being moved from the weak and the worried and the weary, but fortunately they're being bought by the strong, the value, the mutual funds, those long onlys. It will take some time for this to evolve, but it will happen. Inevitably, the companies will put those earnings results on this first quarter, and it will move. I don't know if that's a start. Kim?
No.
Well, I mean, can everybody hear me? Is this one working? No, I don't get so. It's not working. Now it's working. Now it's working. Okay, cool. No, I mean, same thing, just a little shorter maybe, but it's the flip side of being on a public company, that all the investors are looking for what's bad today and what is the good story going forward. We have had our story in a way, now we're delivering it, and people are not looking at what we are delivering, we're just delivering what they expected, and they exit and they go in for the next low. And as I said, that's the flip side of being public, I think. And I think Paddy put it very correctly a few moments ago by turning the question back to the analysts and start to look at numbers and view us on our performance rather than the next nice story.
If I can add on this, you know, I think that often you hear a lot of stories that people don't see, I think, a lot the good side about stories. You know, we hear a lot of sell-off in the product tanker stocks, and yeah, but price of oil is coming off. And nobody's seeing the correlation that what started to impact dramatically positively our income has been the price of oil that's coming down and refining margin came up. Then you hear, you know, China is slowing down. Great, China is slowing down. That's not good for certain segments of shipping. But actually for products has been good because what they were not consuming, now they have to export it because refining margins are good. And there is a new route created out of China for some products. So I think people sometimes miss that what's bad for some people is good for others. And often it's been the case that for product tankers has been a good news, and some of these negative news has been for the world. We've been very anti-cyclical on these news. The price of oil collapsing has been a great story, and I think it's been impacting very positively product tankers. China slowing down has been another good story. And here you have a lot of things. I think there is a lot of doom and gloom and people focusing on the glass half empty and refusing to see that sometimes can also be half full. You know, I think we always try to see that we try to find the negative side of every story that's being presented to us.
All right, so there you have it. I fully expect that by this time tomorrow, all your respective stocks will be trading at NAV. So,
yeah, but hold on. This is this word NAV, right? Expect all the stocks to be traded at NAV, and what NAV goes up and down every second. So on the one hand, your NAVs at the moment, all of our NAVs are probably low at the moment, because you're in this wonderful sort of place, and it really is wonderful for the long term, for earnings, in that nobody's ordering product tankers. Nobody's buying product tankers. Investors across the board don't want us to buy ships. They want us to buy stock or give back dividends. But this is going to put a check on the supply side. Nobody is raising money to acquire ships because their funds aren't there to do it. The private equity guys are getting out more than they're getting in. So you're not going to have this new building position. So yes, you may not have NAVs as a result of S&P moving up at the moment, but you're having that forward curve improving every single day that capital isn't being used to order new buildings or acquire vessels. And the question really in the markets itself is, look at the cash flows of the companies, because the cash flow, when companies are fully funded like they are in the product space, like our companies are here, when there's no reason to raise equity, the cash flow itself becomes dynamic. It doesn't sit on a balance sheet doing nothing. It either repays debt or it buys out stock or does something accretive. So looking just at the NAV, I think, just understates the true value of a company when it's reached a market point and levels that these companies have reached. Sorry about that, Ben.
No. Well, it's your panel. I'm just here to, be the sideshow. So, to the extent that everything is below value, however you would want to categorize that value on a cash flow basis or NAV or whatever, maybe it would be helpful to identify fears and concerns that investors may have that might be causing this dislocation in value. First, on the demand side, I think it's been well documented that there's been a growth of export-oriented refineries, but the product tanker market is very opaque, and you have a high degree of arbitrage trading opportunities. And I was hoping that you guys might be able to expound a little bit on what part of underlying demand that has kept the market strong in 2015 is actually permanent and sustainable versus transient arbitrage opportunities. And why don't we start? TORM, I know, has done a lot of work on this in the past, so why don't we start at the end?
Thanks for that. Well, I think in general, as you point to the trading opportunities that we are seeing with our clients, it is an opaque picture, and it can be difficult to sort of pin down which of those will be consistently there. But I think one thing that we at least clearly see is that China, which is sort of an overhang on the global economy as such, will they pause? Will they go into a recession? What will happen? Really, China has been over the past year a truly success story for the product tanker market, because the refiners in China have had a disconnect between their output of gasoline versus diesel. And we are bringing in, combined here on the panel, I'm sure, a lot of product into China today that none of us saw happening 1 or 2 years ago. So that's really a completely new fundamental trade, which has nothing to do with price arbitrage. And again, also the exports out of China on diesel, which has grown fourfold, is again a smaller story, obviously, because it's coming from a small base. But again, the fact that a country of the dimension of China, that they have this imbalance of a lack of gasoline for their automotive and an excess of diesel, is simply, again, a positive story for the product tanker market.
Anybody have any idea what percentage of the current underlying demand is trading or arbitrage related, as opposed to, just point and destination?
About 9.62453.
Just slow that down.
No. 8.653.
Yeah, maybe on a bad day. Look, let's talk about this point of trend. Look, you're going to have arbitrage, right? You've got loads of different commodities, loads of different grades of the commodities, and you have thousands of points where product tankers are shipped to in the world. You will have arbitrage. And that is a good thing, and that's going to continue to grow as the companies that do arbitrage get bigger, their market gets bigger, their dislocation opportunity gets better. But it's not really, it's very opaque at this detail. You know, Kim and I could probably go on for hours about our 1.11162 difference on arbitrage positions. But the reality is really pretty transparent that gasoline use, for example, in China has been going up. That's pretty transparent. It is pretty transparent that vegetable oil use in the world is going up. It is pretty transparent that palm oils, whether it's used for cooking, you know, washing your hair once a month, or as a substitute for milk in your Starbucks, palm oils are going up. The core cargoes being traded in the product market are going up, and multiple destinations of the world have growing demand, whether it's South America, Africa, Australasia, India, China. You really cannot, and it is a futile attempt, to try and get this granular to the 0.33 decimal point in each trade.
I would say this basically the same thing. The true demand versus the arbitrage. The beauty number one is that we do not know, and the beauty number two is that it is, as Robert is saying, it's a combination of both, and we have these disparities around the world, you know, and you ship gasoline from Italy into Saudi Arabia every now and then. I mean, that's an arbitrage. You can't really, you know, figure out how much percentage it is. But the primary reason for the upturn in 2015, in my view, is the underlying factual demand as such. And I would, you know, if I were to put the number, not as exact as Robert, but I'd say 75-25 in favor of true demand.
Well, you had also a big pickup in 2015 of gasoline consumption in the US. You had a bigger driving season, and I think that will also continue in 2016. It's been a huge...
And in the end, in terms of refining capacity dislocation and how it affects the trade, I mean, look at the numbers. If you want to look at numbers, for example, look at how Saudi exports have increased over the last couple of years by more than 80%, if you would like a percentage. That's because on the back of two refineries that came online. So you do see what we have been talking about, the new refineries in the Middle East, in India. You see it's very easy to quantify them as long as you look at the export movement. Now, what is, I guess, driving these exports, if it's more demand in India or more of an arbitrage trade, to be frank, I don't think people care or can quantify.
Okay. So let's work under the assumption that demand will continue to grow at some very nice rateable level. One of the other things that I often am asked in meetings is, well, fine, you have strong demand growth in the product tanker market, and rightly or wrongly, people tend to have a little bit more of a question mark with respect to the crude tanker market and its underlying growth. So is it possible, in your view, for there to truly be a disconnect between the product tanker market and the rates on product tankers relative to the crude tanker market? And is it possible that, you know, if the crude tanker market doesn't really play out, the product tanker market could remain at elevated levels?
Well, if you look at the number of ships between the, let's say, MR1 size up to Aframax, that's about 3,400 ships. 70% of that, it's coated ships. I'll give you that these are mostly product tankers, the MRs, that make the majority of those coated ships. But today, about 1/3 of the Aframax fleet are coated vessels. As you know, it is very easy to go from clean to crude. It only takes a decision. But once a vessel goes dirty, it's not as easy to go back to clean. It is expensive, it takes time, and if you've been on it for too long, you might even need to dry dock the vessel. So, for example, in the first half of 2015, you had only a limited number of LR2s going into the dirty trade, despite earnings being quite robust. So while in the medium to long run, if the economics make sense, I think it will be very difficult to see a differentiation or a material differentiation between the relative earnings of products and crudes. You have to take that into account that it's not as easy to go back from clean to dirty as it is to go from dirty to clean.
We've actually started exactly that question, and what we've seen is that in the period between 2000 and 2010, there was a relatively strong correlation in the rate environment for crude tankers and for product tankers, with a lead time of 6 to 12 months. However, in the period after 2010, you have had a decoupling to a much bigger degree than before, and we are of the firm opinion that that is because of the restructuring of the refining capacity taking place in the Middle East. That's coinciding exactly with that, and that actually you will be able to see that freight rate environment will be able to decouple in these two segments to a much bigger degree than what was historically the fact.
Any alternative opinions?
I just think this is an amazing opportunity, because I think in the end I agree with Tom that you will have this decoupling. But I do also think that until it happens, it's going to be impossible to change the perception that when people do the analysis, they will go back and they will see things that are very highly correlated to crude. So I think that for the months to come, you are going to continue to have this perception that there are coupled. So when there are scares on the crude oil rate, that'll allow for scares on the product rate. But if you follow through, I think that those scares, those sell downs that you're going to get on crude that will take down products with it in the stocks, those should be seen as opportunities, not a sign of crisis.
Well, I differ a little bit. I think over time there will not be a disconnect. I think they will be coupled. They will always be coupled, always been coupled. They're working like, I don't know if the analogy is good, but milk and yogurt, you know, they work together. And the common name is oil, and you can't really put Arab Light into a BMW and drive on it. So they are based on the same fundamental economic base and conditions. So I think over time they will be coupled, continue to be coupled.
Well, I think they'll be also go back into being coupled, but I think also we should also not forget that the product trade is something where ships can carry over 300 different products. So there is so many things. I think we should also take a macro view about where the world is going, what's happening. I think it's a vision where you start seeing that plastic is consumed all over the world. There is a recovery. The gasoline in the United States has been increased consumption, because for sure there was more driving, longer driving season, cheaper prices. So I think very much is tied also to the general state of the economy, because also we should never forget that in developing economies, we start from a lower base, so the growth in absolute terms is the highest. But if we go down on a individual quota of consumption of products, I think the Western world is still per capita we're the biggest consumer of refined products. So if we start seeing a recovery in the United States, slow patches, green shoots of recoveries all over the world, this has a tremendous impact, because we start going back in the consumption picture, and what we're consuming has to come from further away than it was coming before. So these are kind of facts. You can't go around the facts. Then you can probably discount them a little bit, but at the end of the day, if consumption goes up, what we're consuming has to come from further away. So you need longer ton mile, more ships, and this is good for the product trade.
Okay, so there's been something to me that is absolutely remarkable that's been happening in the past 9 months or so. Rates have been pretty high, and really not very many orders have been placed for product tankers. And it almost, I'm sure I'm wrong, it almost feels like there's discipline in the market. Okay, so tell me I'm wrong. Why am I wrong that there's no discipline in the market?
Because there's never discipline in these kind of markets. I think that the lack of orders, like has been the lack of recovery of prices on the second-hand ships, which are actually something that personally I'm very puzzled about. Looking at it retrospective, being for lack of financing. I think a lot of banks are coming out of shipping or reducing their exposure in shipping, as per all segments. I think that there is an issue of development of tier 2, tier 3 standards on ships. Tier 3 is going to cost $1.5 million, and there's this big tug of war between yards and owners who's going to pay it. Yards cannot afford to pay it because they're having serious problems, and owners are not going to pay it because they don't want to pay it. So I think for all these reasons, you're totally right. For all these reasons, we've been seeing a market that's been good and not followed by a tsunami wave of orders that, has been a wall of new orders that is coming through, which I think is very comforting. And I think this is part of why personally I'm positive about the next years.
So what you're saying is if only banks were more cooperative and share prices were a little higher, that you'd be in Korea rather than being here right now.
No, absolutely
That's not what I heard.
No. What I've just said, we've been in Korea, we've been there extensively, we've been there for 22 new buildings in the last 3 years at good prices. But, I think everybody is not disciplined, but, I think at least most of the people around this table, there is a time to grow, there is a time to consolidate, and there is a time to sell all the ships. I think you have to accept these facts of things.
I think also, Ben, apart from the lack of new capital coming in, that is, be it from public companies, be it from financial sponsors, and the lack of, or more limited ship financing, you also have to take into account that there are a number of owners that are in the tanker space or the product tanker space, for example, but also have investments in container or dry bulk. Today, the same investors the same owners are being asked to take any earnings they get from their tankers in order to support their other investments. So what I'm trying to say that many private companies who would traditionally participate in a better market like that are constrained by their existing exposure. So that's another factor. In addition, many shipyards predominantly that build product tankers, are currently under court receivership or are managed by banks, and they are constrained up to a certain extent as to how low they will go in order to compete for orders. And of course, it's a good thing. I'm not saying it's a bad thing. But it is all these reasons that have constrained new ordering. Unfortunately, it's not owners' discipline, but it has been definitely good for the space.
And I also have to say that whether it's discipline or not, maybe too early to say it's the discipline is here, but I think there is a humble respect that we haven't really been through with all the deliveries from the previous tsunami. So I think that's part of the reasons why people are hesitant going out today.
And then also to add another thing, at the end of the day, I think in the product business, the shipyards who can build, good shipyards that can build product tankers, are not that many in the world. I think probably there are 10 of them. They're very concentrated, especially in Japan, mainly Korea. So it is a kind of a strong barrier to entry. When you have those yards which they're trying to consolidate, they have problems of deliveries and trying to group together in order to diminish the output by consolidating together, I think you can have an impact right away. You know, the big Korean yards, I think they're going through some tough times, and they're trying to consolidate in order to diminish the supply on the market of ships, which is a good thing. China, we're not that touched particularly by China. They're very few and far apart. The good shipyards in China can do products. And Japan, you have a picture of a few yards which are very busy building container ships, dry cargo ships, delaying those. So it's such a mess there that you won't see much coming out until 2019 of new orders.
Share this opinion. Actually, we think that this actually bodes very, very well for the product tanker market. It will have a longer upturn potentially, not because of necessarily this panel's discipline, but because of the economic rationale that it makes no sense for us here to be pursuing new builds at this stage. There's simply better options out there in the secondary market if it was so that one wanted to expand our business, and that will go for a lot of investors. So the lack of capital, the fact that there is other options available, and the fact that shipyards are not going to be able to compete with these secondary market prices will lead to a prolonged upturn for this market. So we're following this, and we agree that this probably not because any of us will not make new orders and being disciplined, but it will prolong the road for us for making a lot of cash.
Okay, so this will be my last question, and then we'll open it up. With maybe the exception of Jerry and Capital, I would say that the other four of the companies here are relatively homogeneous. Everybody has their own unique ships and eccentricities and specializations, but let's be honest, it's all product tankers, and it's, you know, the capital structures are somewhat similar. Product tankers in particular are an area where I think you can make a pretty good case that economies of scale are actually somewhat helpful, that they might not be in other areas. Why are there so many of you guys here today?
Four.
Because it's really fun. Look, there have been some very irrational capital allocation plans from, you know, we had 3 or 4 years ago, a few original companies, you know, in the market. And then all of a sudden, you know, thank you very much, everybody was happy to fund Scorpio tankers. Then, it wasn't good enough to fund Scorpio tankers and not just keep allocating to these guys. You then had to allocate money to new competitors to Scorpio tankers. So capital is not the owners. The capital has continued to fund the fragmentation that there is in the market. And at the same time, you know, some of the companies we've been phoned up at Scorpio tankers, you know, asking to buy shares in various of our competitors. Because the other side to those trades need liquidity at the moment. These private equity guys need liquidity. They should look to themselves. They should do consolidation amongst themselves. That would be the most effective position to move forward. And we've been saying that now for months and months and months. So the simple answer, the flippant answer is it's because it's fun, okay? When companies are cash flow positive, there is very little incentive either for the seller to sell it below NAV, and I'll use that horrible word NAV, or the buyer to buy above NAV. So you get a standstill. So it is really up to the allocators, the investors, to, if they want consolidation, to drive consolidation forward. You don't need to have consolidation for your commercial platforms. TORM's platform is far bigger than the platform they have of own ships. They run pools. So does Marco. Kim's platform is much wider than his ownership of fleets too. So all of us have enough critical mass to service our customers, to win contracts, to get market information. So that isn't going to be the reason to get consolidation. The capital side has to push that.
All right. And does that suffice for the, Robert speaks for everyone, I guess, huh? Good. All right, well, we have a few minutes left, which was my big plan, so that we're not all here too late. I guess if we can take questions from the audience, if there are any. Okay, up here in the front.
General question, we've been talking about business as usual, the way we are doing business now. Have you given any thought to some of the technology impacts? I know shipping is not a high-tech industry, it's my view. And especially now if you look at the demand, say for example, petroleum, electric cars, I don't know if it's going to happen 3 years, 5 years down the road. In the product shipping, I'm not sure the percentage of crude versus refined products. Have you thought about something, what's going to happen, or are you going to go the same way of Kodak? So are you thinking anything in those terms, or you just say it's going to be like this forever and we keep on going?
Look, I think forever, nothing is forever. So I think I'm sure also within all the other companies here, there's always a big debate within the company where we stand now, what's going to happen, and where we would like to be in the future. I think that the electric revolution is still a little bit far away. Probably I won't see it happening, but I think it's going to happen one day. So I think it is a right question for companies of our size to be questioning what we would like to do in the future, where we would like to be, what space we would like to do, and what we would like to be doing. I think probably something that's kind of natural for companies who are in liquid cargo is to be looking at gas. That probably has a certain impact. But it is a big question that normally we discuss kind of, and for sure we discuss more of it these years than I've seen in the last years. So it's something that's really in the forefront of our discussions, where we are now and where we would like to be 10, 15 years from now.
Any other questions? All right. Well, I don't. Far be it for me to finish early. What about this? Have you guys seen any impact from the lifting of the ban on U.S. crude exports into the product tanker market? That was something I think in December and January, or December specifically, people were all concerned that the world was going to be different. Is it different?
I think there was a good play written on that subject some years ago by Shakespeare, right? Entitled Much to Do About Nothing.
I'll take your word for it.
Also the other big thing, that we're seeing in the world is also of Iran being back on the scene, So this, I think, is something that will have to be evaluated, how a big oil producers coming back on the free market, what's going to mean for all of us. I think it's going to be positive. But
I think, in a serious point is that we take a tremendous lot of phone calls, I think all of us, on this sort of US-centric focus on TC2 and triangulation. TC2 and triangulation. The world of products is way bigger than TC2 and triangulation. And so I would, talk to your analysts, get up to speed on what's happening east of Asia, what's happening in different trade routes. And that's about the strongest tip I can give you is that the world of the product market has really transformed itself in the last 10, 15 years. It's no longer LR2s just going TC1 AG to Japan in naphtha, nor is it just MRs doing some triangulation trade in the Atlantic. And anybody just focusing on those things is I don't think any of our fleets or earnings are reflecting that at all.
I think it's not reflecting it, and also, I think all of us have different stories. You see some very strange trips. I don't know, we have seen a trip of naphtha from the U.S. Gulf to Japan and coming back jet fuel from Japan to Florida. So, I mean, how that makes sense. There's no route for that, but, it's happening more and more. It's all about, I think, I imagine a little bit the role of product tankers. It's like in the human body, the capillary system. We are the one who brings the blood through all the smallest part of the body. And there are the big veins, the big arteries, but then you have all this capillary system, which is very all over the body, bringing blood to the different parts of the head. And we have that kind of function. We bring products all over the world. So I totally agree with Robert. There's much more to say than just the big routes and what's been written a few years ago. I think that will gives you just one part of the picture, not the whole picture, I think.
Now, I would also say, for me, one last thing is that, so from the inside, what we could be talking about, and this may sound very callous to a group of shareholders that have really bet on the correct fundamental call, and it's happened, and have empathy as shareholder myself to the stock prices in the product fleet. But from the inside, it's like, you know what, let's keep this capital constrained for just a little while. It's pretty good. It's pretty good that supply side is ticking downwards on that new building growth order. And just maybe in 6 months, it's just too late to put enough orders on to stop a really explosive product market, in the pretty short term after that.
All right. Well, that is ending on a high note. I will say I'm a little disappointed that I wasn't able to negotiate any mergers. That would have been a nice fee for us. But nonetheless, thank you guys all very much for your time. That was very insightful. And Nicholas will turn it over here. Capital Link is really in my opinion, the best connection between global shipping and Wall Street. It is very friendly to both the shipping companies as well as to the investors, and is really a true asset to the industry. So I think probably the most important aspect of the markets and shipping in general at the moment is, in the long run, cash flows and balance sheets are still and will always be how companies are valued. And there certainly is a disconnect of valuation at the moment, but to the extent that companies are able to maintain strong cash flows and good balance sheets, the capital markets will rationalize at some point.
I think we have been always in Capital Link in the past, and for us it's one of the events where you have to be, and we participate also in the London event, so for us it's a very important event to be. A lot of people are here, a lot of contacts, so it's an important event to be. Well, the message of the panel on the tanker side, that notwithstanding, I think, investors' cold feet in this moment towards shipping, I think the tanker is a very good segment to invest, had very good returns, and we expect this to continue during 2016 and probably 2017.